Most businesses that have succeeded, that have that big success in Africa at that time, there were 9 unicorns, 8 of them using that commission-based model because they were enabling other people to make money. And I went back and said, in Africa, because most businesses are small, pretty informal, one of the biggest job to do for most people in the continent is to increase their revenue, increase their income. Any business that can enable them to increase their income will particularly succeed.
Dotun is the managing partner at Ventures Platform, one of Africa's leading seed stage VC funds. He was a growth consultant at Flutterwave and sat on the board of Moniepoint. In this episode, we cover everything from pre-seed investing to what it takes to build billion-dollar companies in Africa. Hi Dotun, thanks for coming on. I truly appreciate it that you're here and really looking forward to this conversation with you.
It's a pleasure to you.
Through the podcast, a lot of early stage founders reach out. And I mean, you invest at pre-seed sometimes, most of the times at seed. Now you also follow on at Series A lot with the new fund you raised. And they have an idea. They're maybe at like 5K monthly revenue. Where do you think the threshold for pre-seed startups in Africa right now is in terms of revenue, in terms of traction to be investable?
The pendulum shifted after 2021 when investors got more cautious because investors have made a lot of bets in 2020, 2021 based on assumptions around the market, the assumed momentum, and follow-on funding assumptions where you can invest in a company at an idea stage at $30 million pre-money revenue, post-money cap, their pre-revenue, pre-launch, but you're betting on how big you think the market is, how good the founders are, and also more importantly, your assumption around follow-on funding. That if this company can do X, Y, Z in terms of the traction, it might not even be a lot. There are other investors that will come in at double or at a premium to what you came in. That is the most important assumption that people have, even though they don't verbalize it. But that's an assumption they have by backing pre-revenue business at a certain valuation. That someone else, if they do X, Y, Z, someone else is going to pay this at a high premium that will justify the price that we come in at. Now, post-2021, the latter part of that assumption broke down. It broke down in the sense that there were fewer money chasing deals. A lot of time, the opportunity or the founders or the execution of product has not even changed. Actually, if in any way, product has got more better. Quality founders are now on the scene since that time. The market has even expanded in certain categories since that time. But what has shifted is follow-on money and the availability of follow-on capital. And that started making a lot of investors to start getting more, the sentiment became more conservative. That actually, I would rather not fund a pre-revenue business, or I would want them to have a certain amount of money or revenue in place before I can fund them, because more revenue means that they can actually get wider vista of an investor that will come on down the line because they have proven revenue. Or B, at a worst case scenario, they can run towards profitability, keep the business alive until someone else can come and fund it. And that's why people started optimizing for revenue. And that's the sentiment. And I share those sentiments. It's very important sentiment, especially in Africa where there are lower number of follow-on investors. There are less capital coming into the continent, dedicated to the continent at Series A, Series B, and beyond. So revenue is quite important. And I share that and I understand that sentiment where people will say, if you're pre-revenue, it's going to be hard for you to get money. Or if you don't have any traction that people can index against towards your next funding round, then it's very hard for people to come in at pre-revenue, at pre-seed.
No, absolutely. Just to double down on that, obviously in 2021 and pre-2021, interest rates were super low. Capital was available abundantly, and founders even in the EU and US thought capital is going to be available forever. It's going to be easy to raise. And then post-22, something shifted. You've been investing for a long time in Africa, and you also were on the operator side. What was one belief that you held pre-21 about investing, also specifically in Africa, that post-21 you changed?
Good question. But before I answer that, I want to really quickly close the loop on where I shared those understanding of people wanting to fund company. We take a view that we pre-revenue business we can still fund at pre-seed. And the key things that needs to stay true for us is the market has to be big enough, relevant for Africa. The product has to be good, but the most importantly, we index for the founders. The founders have to be people that we actually believe can execute it, and they just need the funding to get it off the ground. And we funded quite a number of pre-revenue business. So we don't have a threshold for pre-seed business if those three things matches. And of course, the barrier is high. Then founder indexing for founder can be a bit subjective, but you have to go into their past track record. Now, to your question about things that shifted for us pre-2021, right? That some things that we believe, is that a question that we has shifted now since post 2021?
Yeah, or even also for you personally, the way you invest, the way you see investing.
Yeah. So I think the fundamental one for me, and I think it's more me personally, and maybe we're taking a house view a bit on this, is the cap, the market cap, or don't actually not the right word, the inelasticity of the African market cap. What I mean by that is, no matter how big or how good the company has grown in Africa, some people call it Africa discount, but it's not discount to me. It's more about the cap, that the valuation of companies in Africa is inelastic. It doesn't, not like it changes. It will change over time, but there's a ceiling to it. And there are companies in Africa currently, which if they're not in Africa, traction with the team, with the revenue, they will be 3 or 4x the valuation that they currently have. And that reality is very, very big. And you're constructing your fund model about which company should you invest in and that will return the fund. It also has implication on the kind of returns that you can have as an investor in Africa, knowing that all things being the same, company in Africa doing the same as the company in even South America or India, attacking the same type of market, growing the same way, the same quality of team and bench, there is a market cap, or there's a ceiling for African businesses. Now, that was not something I considered a lot pre-2021, but post-2021, and that's a reflection on the amount of money coming to the continent. It's a reflection on the confidence of people on the continent. It's also a reflection on the amount of investors that are willing to take the risk on the long term on businesses on the continent. And so that shifted the way I value companies when I'm coming in, because I know that no matter how much these guys execute, there's a ceiling. Now that ceiling will shift over time. The most valuable company, most valuable startup in Africa currently is Flutterwave, which is over $3 billion. That's the most valuable in terms of their valuation. And I think that company, if it's elsewhere, should be maybe more than that. One of the companies that has the most revenue, maybe the most, but the one that is out there is Moniepoint has one of the big revenue. Now, for that business, they should be 4 or 5 times the valuation that they have if they are executing in a different market. And that understanding makes me to start thinking about how do we value business, not just value, but how does founders in Africa, how should they be capitalizing their business as they scale? Because if you overcapitalize yourself, you're going to have dilution problem because of that ceiling. And that dilution will have a big impact on you as a founder and on your investors as well, and the profile and return profile.
No, absolutely. If we're talking about Flutterwave on Moniepoint, and it's funny because, I mean, you were a growth consultant for Flutterwave, right? And you were later on, when you invested with Novastar into Moniepoint, you were on their board and also their chief commercial officer. What do you see with those companies, and you saw both of them quite early on in their journey, that were clear indicators or signals that they were going to be successful?
Interesting. And I would do for both of them the things I can see that was clear for both, and was the uncanny and unrivaled depth of knowledge and understanding that both founders had about the market they're going after. I say it's unrivaled because there are few people that have that kind of understanding that they both had. And it was a privileged information that they had. Both of them have worked in the sector that they were innovating around. They worked there for other people. One of them worked in a bank and saw that gap. The other one worked in InterSwitch and saw the gap. And they worked for a while. And that knowledge, that experience communicated in them seeing clearly, very clearly, more than most people, the gap and how they can execute against that gap, and also how they can get the team around themselves. So first of all, in that understanding, the depth of understanding that they have about the problem they're solving. The second one was how they were able to, the ability to attract the right people, team. GB and Tosin were able to attract very deeply technical people from early on. And also, both of them are technical, by the way. Both of them they are coders, so they understand code and they think in maths. So when I was working with GB that early time, when I was group consultant with them, I'll see GB come to the office and he's working on a prototype. There's a time he was working on a micro POS, and he was doing it himself. He was working on it, and he worked, and he shouted, "Hey, this worked!" And he was testing it with everyone. And he was CEO, and he was doing that before getting everybody to work on it. And there was a time also we were working on a website, I think a new product, and he was convincing the team to work over the weekend, and we were getting all the developers and product managers to an hotel to work marathon over the weekend in order to launch the product within a short time. Now, that level of detail of knowledge and technical depth, and also being able to attract the right team and speak the language, was common to both Tosin and GB. Tosin, for example, when I was working with him, he's more comfortable doing a product meeting and working on a product and a meeting for 8 hours. I've been in a meeting with him for about 5 hours before, where it was a meeting, people come in and working on a product, people will come in and come out, and it will call you in for maybe a manager for something, and they will discuss that, and then you get other people to come in and get all their report and everything for 5 hours. I've been in that kind of, it's more comfortable, it's more energized with this kind of meeting than being at an investor meeting or pitch meeting for 30 minutes. So that understanding of the depth of the product you're building was common to both of them. And I think that stood out from early on when I saw them. And I think it was not surprising that Moniepoint was able to win in the category they are in because of that level of detail. And not surprising for GB as well to be able to execute and win in this category because of that level of knowledge, of the depth of knowledge of their market, and also able to of their business, of their product, but also be able to attract the right people to build with them.
Yeah, absolutely. It's interesting because I also in Germany I also worked with executives and also founders that build billion-dollar companies, and they're all like completely obsessed. Like they're absolutely obsessed with what they build, and that obsession and that single-mindedness then also attracts other people that think like that, and that makes building the company easier because you have that top-tier talent that can push towards the shared vision. So yeah, super interesting that you also had that experience there. Previously, you mentioned this cap that is set on African companies just because they are targeting Africa as their primary market, even though the likes of Moniepoint is incorporated in the UK, right, and Flutterwave is incorporated in the US. What do you think has to happen to break that cap over the next years and thereby also expand in a way the outcome size that venture capital can have on the continent?
Yeah, so the way to break that cap actually is not even by them domiciling the registration in different markets. So Flutterwave and Moniepoint, they are both domiciled. The old co is both domiciled in Delaware, and like most startups in Africa, are domiciled outside Africa or Mauritius, outside the market, outside the operating place they're in. That doesn't change stuff. It's basically where's the money coming from, and it's very simple to look at it. So the disposable income in Africa, and the biggest market in Africa, maybe will be in South Africa. I bet it will still be like maybe 5x lower than the US disposable income per household or per capita. And if you look at that, and you can look at GDP as well, but if you look at disposable incomes, if disposable income for people is about $21, they can easily buy products that cost $2 or $3 or even $10 per month faster. The decision making is faster than where disposable income on average is $3. And that the depth of the market in Africa, not just the number of people, but the depth of the market in Africa in terms of the dollar depth is very low. And so for you to shift that cap, you have to either be across a lot of African market. Actually, 3 things you can do. One is to be dominant in your primary market. So you own that primary market and can demonstrate that you can grow it. And that's what Moniepoint did. They're dominant in Nigeria, and they also demonstrate they can grow that market beyond what they have currently. So not just a share of the market, but they can grow the market pie as a whole. But they're dominant in the primary market. The second, then you have to show that this is translatable. You can translate translatable to other African market that they have similarities. So you can show that expansion and you maybe not dominate all those markets, but you can show that you can get more additional revenue for the market. But the most important one to be able to shift that cap, and I said that cap is, I used the word cap, it's not a permanent cap, it's a transitional cap because maybe 3 years ago, 4 years ago, it was lower than that, but now it's shifted. But the way to also do it is then to then demonstrate that you can expand beyond the continent in terms of dollar value. So a company that is doing that, one of our portfolio companies doing that well is Lemfi, where they're now expanding to Southeast Asia and generating good income from that region. Now, if you can demonstrate revenue and growth in revenue from other regions beyond Africa without losing your base, then you are shifting the way you are valued as a business beyond the continent. But more importantly, beyond generating revenue from other market is you being able to then attract capital, attract investor that is seeing you beyond Africa and a non-African investor at the list stage where they come in. And when people see that, then it shifts you away totally from that. You have escaped that cap. Because then that investor, maybe they have the reason why they're investing is maybe they have a goal, or they can also get to the next stage where it at least or be able to help you to expand to market on the continent. Now, having said all of that, I'm an African investor, and my fund is primarily for Africa. I still believe there's a lot of potential that we have, and that we can return funds on the continent. We just have to do it with the consciousness that that our market cap is inelastic, and then we need to price accordingly or capitalize our businesses accordingly.
No, absolutely. The thing that stood out for me specifically, because that's also something, I think it was on the Afropolitan podcast, that Ibrahim Sanya from Silverback, who's also an investor in Lemfi, said that even when he invests, he assesses the business and thinks about the future if it can earn steady cash flows and revenue that is USD denominated outside of Africa, right? Is that also something that you already ask yourself when you invest, and that is a hard criteria for you to invest at the end?
Yes, a big criteria for us that you must be de-risked beyond certain currency. So now it's not a hard line in the sense that you can, Moniepoint achieved what they achieved without having dollar revenue for a long time. Maybe they are now with a money world, but for a long time they were not dollar revenue. The most money they were growing, and it's a market that is expanding. So, but it's a thing that we think about, and criteria is that you can demonstrate that you can diversify your revenue quality. We actually have an in-house framework for that, for assessing our companies before we invest and after, and for follow-on. And it's called the GRIMT framework, so growth, revenue, market, team, and technology. But the revenue itself is divided into 3 aspects. One is the quantity of the revenue, that's the revenue run rate, and then the quality of the revenue, which is the margin, but then the diversification of the revenue, which is what you're referring to here. And so you score more points if you can demonstrate, or you already have a diversified revenue, which is currency basically. You are not pegged or risk. Your risk profile is not only attached to one particular revenue that can be volatile.
Absolutely. And that in that way you also hedge currency risk automatically, right? If you earn revenue in different currencies, then if the Naira devalues, then you hedge because you still have USD revenue that comes in. You said, and that's a statement and something that I really like because I hadn't thought about it that way or haven't heard it from anybody else who said it that way. You said the path to the $1 billion club in Africa is paved by shared success. Could you unpack that for me and also the audience?
There are 3 types of revenue for businesses, for startups. One is margin revenue, where you buy cheap and then you sell high, so you have a margin business, and that's very common. A lot of people know about that. You put a margin on a particular product or on a particular service, and you make revenue from that. The other one is you're selling convenience on time. Basically, you're selling something that you have, and you can have high margin on that. Subscription businesses, SaaS model, you're selling a particular you're spending time or convenience or a particular product which you can command the way you do that yourself, but that and it's a recurring revenue model. And the third one is a commission-based business. revenue where you enable other people to make money, and you take a cut out of what they've made. And that could be a marketplace, that could be even transaction and payment businesses where you create the rail for people to be able to make payment or cross-border movement of money, or even payment infrastructure and a gateway. And for every money that goes through your pipe, you take a cut, because without you, they will not be able to make that money conveniently or the way they're making it. And I said, and I looked at the data, most businesses that have succeeded, that have that big success in startup world in Africa, and I think I did an analysis of that at that time. There were 9 unicorns. 9 companies have gone above $10 million, $1 million, $1 billion, and 8 of them are using that commission-based model, because they were enabling other people to make money. And I went back and said, in Africa, because most businesses are small, it's informal, biggest job to do for most people in the continent is to increase their revenue, increase their income. And so any business that can enable them to increase their income will particularly succeed. So because you look at those, 80% of the, or almost 90% of the unicorns that are exist on the continent, the way they got there was by enabling other people to be successful. So they built on shared success, and they enable people to have revenue to make money. So business to be able to take payment or move money around, or get the, or Moniepoint, for example, enable SMEs to be able to collect money and give them POS to be able to build their business better, and then they make a cut out of that. Or Paystack, that has done well in enabling merchant to make to accept money, and that's shared success. So you're really leveraging on the number one aspiration of most African businesses is to be able to get more income, because most people are poor. And so for you to build $1 billion business, it's built on the back of shared success. And for now, so that's what our statement was trying to allude to. And it look altruistic, but it's not. It is altruistic to some extent, but it's the reality here, because of the fundamental things that are there, like informal market, low income economies, relational economy, population, and opportunity for innovation to enable people to be able to make money in a better way.
Yeah, absolutely. And that's also where the huge market is at, right? That's when you target those people, then you have a very, very big market to attack, which then also attracts more investment if you're a good founder, presumably. I want to go a bit more on the fund side. Last year you closed the first close of your new fund, targeting I think $75 million, with the Nigerian government participating for one of their programs. With the ongoing reduction of DFI investment in Africa, do you think participation from local LPs, and for anybody that doesn't know, LPs are just investors in funds, the participation of local investment will become more and more important?
Absolutely, yes. Participation of local investors, not just individual, but local institutional investors backing fund managers like us, is crucial and will become very important because of the shift in global focus and global priorities. DFS are still playing a role, but we have to understand the role of DFI originally is to catalyze local investment. It's to help managers like us to prove that venture works and create enough momentum for other institutional investors to step in and see that our model works. And we started seeing that, like what you refer to, the IDAS program is an AFDP program through the Nigerian government. But before that, our first fund, we got investment from NSIA. NSIA is a sovereign wealth fund of Nigeria. So we've had investors from the Nigerian government invest directly or indirectly into our fund before. But this is the biggest one where it's a program through AFTP but managed by the Nigerian government. And we need to see more of that. I'm seeing something happening in Morocco, and nothing maybe happening in Rwanda. We need to start seeing, beyond government, by the way, we need to start seeing local institutions, banks, pension funds to invest in venture like us. And that will be enabled through the success that people like us are making for the DFIs, the international DFIs, who have catalyzed the model and then start attracting other institutions to join. I must say that we've been very fortunate that we've had a bit of that. First fund and now this fund, we've got money from local African-based institutions and banks as well.
Yeah, how do you Because I mean, most of the money that you raise, or that in general fund managers in Africa raise, is USD denominated typically, right? Similar as the startups raise USD denominated venture rounds. Does this, just out of interest, that local money, is it also easier to manage in a way because it's then Naira denominated and you can then invest Naira into the startups? Or how's this dynamic work?
Yeah, so that's a very good question and a very interesting one. So currently our fund is still dollar denominated just because, like you said, most of the startup are dollar valued, even though most of them are making money locally, but they're domicile outside. Most of them are domicile outside the continent. So our fund is still dollar denominated, even with the local investor that came in. But I've heard arguments that there should be local currency denominated fund. The challenge with that, to be honest, is that then you then need to make that fund to only be investing in a country specific area. So if you're doing Naira denominated fund, then we're only focusing on Nigerian fund, right? And then those companies have to be encourage them to be Nigerian domicile, and maybe by making it easier for those funds to do that. But I think it creates an additional problem in the sense that you're limited to only Nigerian businesses. You are also limiting the company to be able to raise external capital because an international investor wouldn't find it hard to then domicile to now be they have to change their dollar into naira and then value the company in naira, and then their book hold it as naira compared to their other fund who are in dollars. And when naira goes down, that means automatically they need to be changing the value of the company on a regular basis.
Yeah.
On a regular basis, not because that is detached from the growth or the potential of the company, but on just the denomination that it is held at, which is different from the denomination of their fund. So it creates more problem than it will solve. I can understand why it will solve problem for pension funds or local institutional fund, but that is if you are really focused only on a particular market, and you also expect that company to raise all their fund from that market.
No, absolutely. I can totally see why that would create more headaches than problems it would solve. I mean, Ventures platform started really in Nigeria and has its roots in Nigeria, but obviously now you're really Pan-African. You're investing in other markets, also Francophone Africa. What markets outside of the big four, outside of Nigeria, Kenya, South Africa, and Egypt, are you most active in, or most actively looking to deploy capital in, and why?
Yeah. So I wrote a very piece on this, on the delusion. Is it the delusion of the big four? And the pieces and the op-ed should be on our website. The thesis is that the big markets are very important and big and good, and they've returned. But there are other markets around it that we should be thinking about. And to your question, they are primarily the francophone market. It's not part of the big four. So Senegal, Cote d'Ivoire, they're not part of the big four. But I think Cote d'Ivoire as a market, not just on its own, but as an anchor market for other WAMU market, West Africa, Francophone region market, where if you build a business that can do well in Cote d'Ivoire under the same regulatory condition and even currency, you might be able to easily scale it to Senegal, to Benin Republic, to Togo. And suddenly the small lakes, they're not big, they're not as big as the ocean, Nigerian Ocean or South Africa or Kenya, but the lake joined with other lakes can now become very valuable opportunity. That's what I was arguing in that piece. So that's the way we are thinking about the market. So Francophone, West Africa is a big one for us as a player, as a next market beyond the big four. And we've hired a very good investor in that region who is based in Cote d'Ivoire. We are also thinking a lot about Morocco, even though it's a small market, but it seems to have very good experienced product managers and entrepreneurs who can build for the wider market beyond Morocco, and who can also be attractive to external French investors. It's a market that we're thinking about a lot.
Yeah, and also the bridge. I mean, if you're talking about Francophone West Africa, the bridge from Morocco to Francophone is also possible, right?
Correct.
Because
Correct.
it's both French. Maybe it's cultural, a bit further apart, but that the language barrier is not there. Also, based on the last fund that you're raising now, where you had the first close to 75 million, other investors, and with that also you're moving more into Series A, right? So other investors in that similar bracket are raising bigger vehicles, like 100, 200, even some $300 million. How do you think about ideal fund size that still allows you to generate the maximum returns for your investors?
Yeah, first of all, I mean, we're not going into Series A. We're still a seed investor. We can follow on our company to Series A and even beyond if we chose to do so. What is 75 million, which is, and our second close will likely be more than that because we will likely be oversubscribed. 75 million will enable us to be able to go in strongly in our businesses at entry and then follow on confident beyond their seed. But to your question, what is the ideal fund size? I don't want to be prescriptive here, but I've got opinions. So the other people that are raising beyond 100 million mostly are not seed investors. So we need more post-Series A investors, the likes of Patek, North Screen, and even Nova Star. We need more of those that can do Series B, A, B, C, and D. So we need more capital and investing in proven business model, proven PMF. But I think if I want to answer your question more narrowly is what is the ideal fund size for seed investment on the continent? Where my head is right now, it depends on your capacity to take on many pains and also your risk threshold. What I mean by that is if you want to invest in a lot of company, okay, you can go beyond a certain amount. And if you have lower risk threshold, I mean, all of us are risk takers. That's why we're doing what we're doing. But your threshold is, and then you can also take bigger risk and say, you know what, I want to be investing $5 or $10 million in a business, and if I do 10 of them, I can do 100 million. So I'll say anything above 100 million for a seed investor on the continent is a bit you're on the line, and it's a bit risky in the sense that I find it hard to be able, not that you can't return the fund, but it will be harder for above 100 million, except you are doing even if you're doing 100 companies, and so you're doing 1 million in average on that, it's still going to be hard. So that's the opinion that we took. And so that's why for this Connect fund that we are closing, our hard cap is 100 million. And also deliberate, not that we can't go past 100, given that we closed 64 million in our first close, and we could easily get to the right stretch. But we're making that cap as an hard cap, and I don't think we should even get close to it because of the return profile on the continent. And we don't want to invest in too many businesses. We want to be conviction led and confident in our follow on rather than just spraying. So I would say below 100 million would be the ideal seed fund size for African VC fund currently, based on other things I've said, and especially that inelasticity of the market cap. But beyond Series A, beyond seed and Series A, I don't know. I've not evaluated that closely.
Okay, got it. And what is for this new fund, or also in general as ventures platform, as a philosophy, what are your ownership targets at seed then? Is like the typical 10-15% ideally?
So our entry ownership, so it's different from the ownership target that we look for in a business. Our entry ownership is 10%. So that's what we aim to get when we're investing in a business, or close to that as much as possible. But 10% of our entry ownership. Then follow on, we will, if it's good, if it's business that is doing well, we want to expand that. Or if they grow really, really fast, I want to maintain that. Ideally, for our good businesses, our terminal ownership, we want to be close to that 10%. So it means that we are following on and defending our 10%, or we're even expanding it when.
Is there ever, or was there ever a case, even now at Ventures Platform, or also before at Novastar, where you had a mandate that you should be a seed investor, and there was because you have a great network and you're well connected, there was a really hot round and an amazing business, but it was already at Series B or something, and you didn't invest, that you regret now?
A lot of them. Not a lot, but quite a number. And that's one of the thing about this business, right? So there are a few companies that we've seen, or I've seen, which we did. They're growing on well. And I wish them the best. It's one of those things. And I just learned from that. That I've seen maybe when you came in, and then for some reason, the market, the recent example was when we saw this company, they are doing something else, which we wouldn't even invest in now. But the team left and they changed, but then they raised money from someone else. So oh wow, we would have invested in what they're doing now if we have seen it, right? But we said, and I'm sure a lot of people said no to their previous business as well. So that happened. It's one of those. I think over time, I call it anti-portfolio, right? So my anti-portfolio will be large enough that I could imagine if I invested in them and I will have more money now than I have.
Yeah, I mean, that's life. You make mistakes and you hopefully learn from them. Um, the last question I wanted to ask, just because it's so present also now with like investors or founders that I talk to here in the West or Europe or US, eventually, obviously, you have the whole topic of valuation, right? And you obviously at some point when you're later stage and you have like free cash flow and it's profitable, you can like do discount cash flow valuations. But at early stage, you usually do like comparables in the private and public markets and in pre-decent transactions. With the development in Western and specifically US public markets for software companies, the multiples going down and also the overall valuations coming down. Do you see that having a direct effect on African businesses and startups, or how do you think about that?
Definitely has, even though it's not immediate originally, but it has impacts. Multiples going down, valuation compressing. One of the big impacts of that is less amount of money coming to the continent, facing opportunistic deals. So in the time when the valuation is, where multiple is better and in different market, you can have somebody who is doing an opportunistic deal on the continent. I mean, a fund, maybe they have $500 million. They're mainly investing in North America and in South America. And someone in the team saw a business in Africa that is comparable to another business in North America. They can easily argue that let's invest in this one because the valuation is lower compared to what we're seeing here, right? And even though the revenue is the same, but the valuation is lower, and we just need to stay here for a while, and then we can get other people to come in. And even at the lower valuation, everybody's seeing the money. But now that valuation is lower in North America, except you push the valuation in Africa down almost to zero, there is little way in which you can argue for that arbitrage anymore. So the arbitrage opportunity starts getting squeezed in Africa on the opportunistic level. So the guys that play in Africa will be the ones that have dedicated fund like us for the continent rather than opportunistic arbitrage seekers. And that adds huge impact on the way even we have to value companies and our assumptions around follow-on funding for those businesses. It's very instructive to note that for Moniepoint, for example, even though it's one of those classic companies that have grown from angel-led seed, VC-led Series A, Series B, and then PE-led Series C. It's very instructive to know that in all of those, most of the money that have come to Moniepoint have been Africa-dedicated money.
Yeah, absolutely. Whereas like other companies that raised a bit earlier, the likes of Flutterwave or also Wave, they still had more US money on the cap tables.
Correct. And the difference is post-2021.
Mm-hmm. Yeah. Do you think investors based outside of Africa can invest very successfully in a larger sample size without being locally on the ground and having dedicated funds?
They can. They just have to be conscious that they are not on the continent and they need to rely on other investors on the continent. And they have to rely on what I call the interpreter investors. Interpreter investors are investors who are local, who understand the context, who are also putting their money where their mouth is and able to interpret certain data, provide the right context, and even lead diligence for those people. Yes, they can. And I'll say they should. We need more external investors and leveraging on the local knowledge of investors like us.
Yeah, amazing. Yeah, I mean, this been amazing. I definitely learned a lot. I think the audience as well. I really enjoyed it. Where can people reach out to you if they want to?
Yeah, the only place I would say easily people can reach out to me or hear my thoughts, even though it's sporadic these days, is Twitter. Also, I mean, my podcast is the next season will be out. Hopefully before the end of this year or early next year. And so people can follow me that way as well. So and I've got a blog or a or Substack channel where I write my thoughts sometimes as well.
Perfect. I'll also link all the links in the show notes. So if you're interested, definitely check it out. I read it in advance and it's super insightful. So definitely do it if you're interested in the African startup ecosystem. Amazing. Thanks.
It's nice to talk to you, Louis.